Yeah. All right, guys. So today we have Disney earnings. Let me make sure we got this right. We're gonna do a poll here as always. We're also gonna do a Twitter poll. Let's get this going live. Hey, what's up, 75? Let me get the music going. Remember, it's quarter 2 earnings for Disney today. Market's actually rebounded all the way back up here. And so this is what I mean. Like, a lot of time Bears will be all doom and gloom, but market flying back up. Hey, what's up, mister? Oh, dude, there's a spider. What? Hey, Carol. Hey, Carol. Bro, I think it might be a Black Widow right here, dude. What is that? Hey, come look at the spider, baby. Yeah, come look at it. I'm sorry, here, I gotta see this thing. Wow, look at that thing, man. Bitcoin had a weird dump. It's a sign? Is it a sign? Let me know if it's a bullish or bearish sign. SPY up to 413s right now. 413s right now. Am I holding anything? Did I cut everything or no? Okay. I should have held PayPal, bro. PayPal. Or no, I shouldn't have held PayPal. I'm glad I cut PayPal. Wow. Yeah, it looks like it was the right move to sell PayPal. All right, so I guess Carol's not coming over here. All right, well, don't worry about it. It's all good. That's not a widow, huh? Right there? Look at this. Okay. Apparently I'm dumb. I used to be scared of spiders. I'm not really anymore. Sorry, bro. I had to do it, spider. Forgive me, sir. Anyways. Spiders are bearish? Are they really? Guys, let me know if you think they're bearish or bullish. Also, we're going to get the poll live here. We're going to do a poll. Hit the like button. Help me if you can. We're going to do a poll here live. Are you bullish or bearish on today's Disney quarter 2 earnings? Vote on the poll, bull or bear. We got the bull or bear poll live right now. We're also going to do a Twitter poll here. Do they beat, miss, or come in as expected? All right, guys, we're going to do our poll options here. Let's see, beat, miss, as expected. And we got this poll live too. We're going to do this 1 hour poll. You can do me a favor, hit the like button, guys. Jump over the like button here. We got the poll live here as well. Again, SPY moving up a little bit today. SPY starting to bounce back a little bit. Part of me thinks I should trade it. It was a liquidation on Bitcoin. Yeah, Bitcoin, guys. All the way down to 26.75 here today, man. That's kind of shocking that they're down so much. And then they rebounded back up. They're almost back up to 28K, so weird. Could be a shakeout. Could be a shakeout. I don't know. Disney drops their numbers. We'll put a timer up on screen, about 30 minutes. All right, so here's the Disney timer. Yeah, maybe. I mean, that could be right about rationale about going back to Disney World. Can y'all hear the music? You should be able to. All right, so on our votes, 50% of people on Twitter think Disney's going to beat, 16 or 17% actually think they're going to miss, and 33% think they're going to come in as expected here. We'll put the Disney expectational numbers up. They're expecting 89-cent profit. They're expecting 89-cent EPS on 21.8 billion in sales. Numbers drop at 405 is what they're scheduled to drop at. There's the numbers right there. Guys, there's the numbers right there. All right, so again, the SPY is actually having a pretty strong day right now. We also have Robinhood earnings today, guys. So we do have Robinhood numbers today as well. So we got Hood numbers. The earnings call is at 4:05 or 4:30. The actual earnings drop at 4:05, so we still got a little bit of time before the earnings. But man, look at these dips in market activity, man. Gold still green on the day, but I have a side hustle of renting RVs. My rentals are down this year. People are getting back to going to Disney World. That's my rationale. Maybe, man, that could be it. Can y'all hear the music? Y'all should be able to. Snap doing well. Yeah, man, I told people about Snap, bro. Again, every time I buy Snap, it's honestly crazy. Every time I buy Snap at like 7s and 8s, people always talk smack. They always get weird. They always act like I'm wrong. They always try to talk me out of it. They're like, bro, I get it, but why are you buying Snapchat? This is why. Snap up to 870s now. This is why I buy Snap. People still don't understand the strategy. This is why I buy it, because it works. All right, 67% of people think we're going to All right, SPY up to 413.70s. So the U.S. congressman says maybe we do print money out of yeah, Google. Honestly, my swing trades aren't looking that bad a couple months later, are they, huh? Again, Snapchat, Google, Disney at 90s. I'll take it. Look at the SPY up here, though, man. The SPY is flying up today. Wow. All right, guys. So again, we bought a little bit more of PayPal here. I've been buying this dip for days. Made a little bit of money on it this morning. I wish these politicians would stop trying to own each other. Yeah, remember, tomorrow we got PPI too. So tomorrow's PPI as well. Very relevant. Yeah, I don't know how many people are really going to be interested in Disney earnings. But hopefully we get a good couple people here. Who do you got? Jake Paul or Nate Diaz? Again, should I buy this dip on the SPY, guys? Is really what I'm looking at. I don't know yet. Is a firm earnings today? Okay, so we got BYND, Mara, Disney, TTD, Unity, BYND, Groupon, Givo, Cheesecake Factory, Corsair. We can cover these. I mean, we'll cover all of them like we do here, but I don't know if we're not gonna stream the earnings call, of course. Disney's the biggest company today, so that's probably the one we're gonna cover. We also have the Trade Desk and Unity. We have Sandstorm as well. Got a little dip here. Google pulling back after a huge run. Honestly, Google's kind of saving the SPY today. You can see the SPY rip back up. We also have Robinhood. I guess the question is, how is Robinhood going to perform today? Down at 907. Doesn't look like it's moved that much over the last couple of years. And so, yeah, we'll see. All right, so again, Disney up to 101.50s here, 101.50s. Robinhood at 907s right now. We're watching the SPY to see what it's going to give us today, too. Okay, gotcha. Hold on, let me check it. My bad, man. I haven't even pulled it up. It's been a busy day for me. I haven't even been home, guys. I just kind of got home. It could be BYND, Beyond Meat. Just woke up after sleep. Don't know if you remember. Hey, what's up, Tim? All good, man. I trust Disney will beat on quarter 2, just being optimistic. Hey, we'll see, man. I hope you're right. You know, it's got a chance to. I mean, again, expectations 89-cent profit on 50 plus. Or no. It's 89-cent profit expectation on 21.8 billion in sales. So again, looking at our poll, we got a couple polls going live right now. Our Disney poll is live too. We got a decent amount of views here. About 61% think that Disney is going to beat, according to our Twitter poll. 22% of people think they're going to miss, and 17% think they're going to come in neutrally. Again, you can kind of see Disney went all the way up to 101.70 and then pulled back to 101.40. What is this? Did he just say mashed potatoes? What the heck is that? What do you think about Beyond Meat? I think Beyond Meat was once a really overhyped company that's now corrected all the way back from 300 down to 12s. The real question that you have with something like Beyond Meat, in all honesty, like the real question you have to ask yourself is this company going to succeed as a company? You know, again, if you put a long-term chart up, like a weekly chart, you can see they've gone from about $2.40 at the highs down to $12 at the, $11 at the lows. And so the real question, how long has it been since you've seen any type of partnership or deals done with Beyond Meat? That's my genuine question, is how long has it been since I've seen that? I haven't seen it in a while. I think Impossible is doing a little bit better in the same niche. And again, I'm not hating on Beyond Meat. I genuinely don't know. For a company that I don't watch regularly for BYND, I really don't know. They don't move that much. They're pretty sideways when they do move, and in the long-term trend is down. And so, I guess the point is, like, I'm not going to pretend to like a stock just to get views. I don't like it. I think it's incredibly risky. I think this company overestimated the interest. I think it's incredibly expensive to produce what they produce, and they don't have a lot of people that want lab-grown fake meat. And so because of that, I'm incredibly skeptical that this company is going to succeed long-term. Again, lab-grown fake meat is just not the buyer interest there has got to be very low relative to their price points. And so I think that's what you got to understand. Like, vegans are very, very careful with what they eat, right? I genuinely doubt a lot of them are going to want to buy lab-grown fake meat that's super expensive. I just can't imagine that they will. Maybe they will. I don't know, but I can't imagine it's super high. The interest there, I can't imagine. It may have been high back in the day, but I don't think anymore. I mean, I'm bullish on Disney long term, Joshua. Short term, I don't know what Disney's doing down here, bro. Let's see what Disney does. Yeah, no worries, Samuel. I mean, what do you guys think about it? I'm open to the listening. All right, guys. So yeah, Disney pull it back onto the VWAP here at about 101s. Many vegans are vegans for health reasons, not. Any tips for Unity earnings planning to sell with 10% profit and buy later? I'm not sure. Yeah, 20 minutes. Numbers drop in about 20 minutes or so. I'm not any guess on Unity direction. I don't know. We can look at their EPS. So Unity expecting 3-cent loss per share on 481 million in sales. So again, we'll see if they hit it or not. Their numbers aren't scheduled to drop until 420. Everybody's favorite number. We'll see if they hit it or not. I should probably stop joking around about everybody's favorite number. People are gonna get the wrong impressions from me. Disney will be down. We'll see. They've had a pretty good run over the last few weeks. You know, here's a 90-day chart. We can put out like a 20-day chart. Here's a 20-day chart. I mean, they're slightly green from it. The whole market's been choppy. Like, here's Disney. Robinhood drops their numbers today, too. It's Beginner Crypto is the name of the channel. It's Beginner Crypto. Google, Google AI news. So again, if you didn't, TTD, the trade desk, is also there as well. They're expecting 12-cent profit per share on 364.51 million. Still a relatively small company. The biggest company in this is obviously Disney. Every other one doesn't. There's not any other ones that do billions except for Flex in terms of quarterly revenue. A lot of companies dropped today, but again, the biggest one. Genpact does a bill too. STE Steris does a bill. Actually, Manulife does a bill in sales. But there's only about 3 or 4. Disney's way bigger than all the other ones. They're projecting 13.3% growth. Looks like most people are voting that Disney goes higher. Again, Disney currently right at 101.30s here. 101.30s. Okay, we got about 11 minutes. What about Roblox? Roblox dropped their numbers this morning, didn't they? And they did bad. And then they rebounded all the way back up. Look at Roblox back up there. So Roblox was down a lot, and they basically rebounded. They posted bad numbers, if I remember correctly, though. Yeah, Roblox posted 44-cent loss, missed the 40-cent estimate. Revenue beat expectations. Actually, their revenue came in higher than expected. So revenue went from 773.8 million to 765.94 million estimates. Yeah, my kid was right, honestly. My son was absolutely right about Roblox, which is surprising. Roblox bounced back, though. Again, did a poll. 65% think we're going to beat for Disney. 24% think we're going to miss. 12% think we're going to come in as expected here. Look at that YouTube. 56%. 57% are bullish. 43% are bearish here. Yeah, PPI tomorrow is huge. That'll be big, too. All right, so Disney cranking below this 101 level here, cranking below it at 101. Robinhood at 904s. Again, PPI tomorrow, so inflation data tomorrow, which is actually pretty big. All right, so again, Disney down. It's at 101s. 101s. Robinhood at 905s. Yeah, Bitcoin, guys. Honestly, tough day for Bitcoin. It bounced back a lot, though, honestly. So Bitcoin dipped all the way down again, 26.7 thousand. It's all the way back up to 27.7 thousand. So the drop's not super big, honestly. We're kind of right back to break even on the day now. We opened the day at about 27.5 thousand. We're at 27.7 thousand now. So technically, we're green today, which is surprising, even though we took this big drop, but we rebounded pretty quick here for Disney. So. So Google unveiled the Pixel Fold, which is $1,800 foldable smartphone. I have the Z Fold. Again, look at Disney all the way back down to 101. Robinhood also releases their numbers today. We got about 7 minutes before the market closes. A little bit more time until the numbers come out. All right, guys. Robinhood. What do y'all think Robinhood is gonna do? Oh, I love the Z Fold. I've had it for years, man. I've had this phone. I've had this phone for years, and again, I have this phone for years, and it is surprisingly durable. And it's great, man. Again, I've had it for years, still kicking, still around. Hmm. Yeah, Disney's gonna be fine, man. Again, every time there's always doom and gloom crowd for Disney, but Disney's gonna be fine. Honestly, it's obviously gonna be okay. It's Disney, guys. Anybody that I get it, people might be against them for whatever reason, but like it's Disney, man. Disney's gonna be good. They don't need to worry about it. Again, the actual earnings call is set for 4:32. So Amazon. What does Amazon do today? Amazon at 110.14s. Yeah, I mean, I'm looking at it, but all right, guys. CPI this morning here. So we had CPI today. Starting to pull back a little bit too. Look at Disney started dumping here ahead of the open. All right, is anybody getting in some dip buys here? Disney on 101s. Again, we got Robinhood on the right side here. About 3.5 minutes or so until the market closes here. We still got Disney earnings are set to be released at 4:10 market time. Yeah, I think Disney will be fine. I mean, Disney just owns so much. They're diversified. Amazon had a pretty good day, too. I mean, the market is finally starting to rebound back up here after a rough couple days. They're a rough opening bell relative to CPI, but we are very green from CPI. Let me see. Right, so here's Epic Pen. Take screenshot, whiteboard. Your screen, do pen. Any direction? Tyson chicken. Yeah, if Disney drops down to that low, I'll probably buy it. Only reason I didn't buy is I don't want to buy a long position on margin. I think Disney's good long term, but short might see fluctuation. Yeah, for sure. Disney earnings. The earnings call is scheduled for 4:30. The actual earnings are scheduled to be released at 4:05 market time. So the actual earnings are supposed to drop in like 7 minutes. The earnings call is at 4:30. At least it's scheduled to. Again, Disney's starting to finally fluctuate back down a little bit. Hey, we did a poll here. All right, guys. So again, the SPY dipping down. Part of me is tempted to buy this dip. Amazon moving back up a little bit again. Disney at 101s, guys. 101s. All right, so the closing bell's in about 15 minutes here. If Disney drops to 99, would that be a possible buy? I mean, it depends. I don't know. All right, so there's the timer. Again, Disney hasn't moved much. There's the closing bell. We got the SPY on the right. What are the other ones that are released today? So we can take a look at these. So Disney at 4:05. TTD is just scheduled for any time after close. We don't really have any that are supposed to be released aside from Givo, which I'm surprised Givo is still around. There's TTD, the trade desk. Again, we can watch Robinhood. Robinhood's not scheduled to release theirs until 4:05 either. Unity is supposed to come out at 4:20. So we can watch this to see if it moves, but they're not always exact with regards to schedule. Sometimes they come out earlier, sometimes they come out later, but they're usually pretty accurate. It's not always, though. You know, it fluctuates for sure. Again, Disney at 101.30s here, 101.30s. Unity at 28.60s, 28.60s. Disney up to 101.70s right now. Question is if layoffs will be visible in that earnings that will buy. Yep, for sure. I agree 100%. Layoffs have been causing positive reactions. TTD pop, so it's TTD out. There's a Disney pop right there. So it's up to 102. I think Disney earnings are out. Trade desk earnings look to be out as well here. I'm going to throw it in sub-only mode. So if you haven't already, subscribe. Team, we appreciate it. But Disney fluctuating a lot, which means their earnings are probably out right now. They don't usually move that much in pre-market. TTD also out with theirs here. So I'm checking the Disney numbers, waiting. It might not be out, but this is a 5-minute chart here. So a 1-minute chart. Again, a pretty big pop-up at the open. I don't see the numbers out yet, though, so could be fluctuating just from earnings potentially being released in 3 minutes or so. TTD flying up to 71s. Still waiting on Disney. All right, so TTD posted 23-cent EPS versus 12-cent estimates. Sales of 383 versus 364 estimates. We'll put these numbers up on screen. TTD just released theirs. Again, we are waiting now for Disney numbers to drop also. But TTD is out with their numbers. Disney, I don't know if Disney's just moving in sympathy with some of these other stocks, but I don't see any results yet for Disney here. Robinhood either. Maybe Disney could just be gapping up because their earnings are today. I'm not sure. Let me check. Twitter is kind of a good place. See if they're out yet. Nope, no Disney numbers yet. So just patiently, happily waiting for the numbers to come out. And again, we'll see if we get something good. All right, no Disney numbers out yet. Still patiently waiting. We got some other stuff drop, but nothing for Disney yet. Again, TTD dropped their numbers. You can see them dipping down. We can look at like Unity to see if they're out with their numbers yet. Unity up a little bit. We could look at Hood. Hood popped a little bit. Nothing up for Unity either. All right, so Disney fluctuating again down here, but it could just be chop. I mean, it's moving a little bit, but it might just be chop. TTD is already out with their numbers. You could look at the bottom of the screen right here and see the trade desk numbers right there. Corsair. I could look at Corsair. Corsair is out. They posted first quarter adjusted EPS of 11 cents, beat the 10-cent estimate. Sales of 354 versus 352 estimates here. We'll put the numbers up in chat right there for Corsair. Better than expected numbers on both metrics. Slightly better. Not a crazy amount better, but slightly better. Here's Corsair. Slightly better. They're not really moving that much. Unity not out with anything. Hood's up there though. Hood's at the top of the range here. I don't think they're out with theirs necessarily yet though. Corsair did better than expected guidance numbers too for the fiscal year. Look at Hood. Okay, there goes Disney popping. So Disney numbers are definitely out right now. Disney down big, down to 98s. So Disney's out. Definitely out right now. Again, there's 1605, so they released right on time. Again, bear with me. They are fluctuating wildly here. Green. So far. Revenue for the quarter grew 13% and 10%. Diluted EPS decreased to 191 from 214 for diluted EPS. EPS came in at 139. Yeah, they're out with their numbers here. Again, 93-cent EPS, adjusted EPS versus 89-cent expected, but we'll put this number up. But yeah, Disney's out with their numbers. We'll put this up in chat. Again, revenue came in at 21.8 versus 21.79 billion, so slightly better than expected revenue. These numbers weren't like amazing, beat it out the park. Hood is actually up a decent amount though. So Disney down at $98. Again, adjusted EPS of 93 cents versus 93-cent estimates. I was showing 89-cent estimates for my EPS at 21.8 billion in sales. They posted 21.8 billion. So pretty flat earnings release here. Oh, yeah, we have Mara and Riot numbers today. I forgot. Are they out with theirs? Doesn't look like they're out with theirs yet. Mara was posting their numbers today. I don't see them out yet, though. Mara might be a little while before they release theirs. All right, but yeah, Disney came in at 93 cents in line. Sales of 21.28. Beat sales, missed on EPS. Or no, inline estimates. Domestic channel revenue for the second quarter decreased 4%. We're putting all these numbers up in chat here so you can see it. But again, second quarter domestic channels revenue decreased here 4%. For Disney. They said Disney media and entertainment distribution revenue came in at 14.04 billion. We're starting to list these in chat so you guys can catch them. Disney Parks experience and products revenue came in at 7.78 billion. Yeah, maybe Mara might be tomorrow before the bell. I'm not sure. Yeah, BYND back up to $14. So it looks like Beyond Meat is out with theirs. But again, we are going to stream the full earnings call live here too, guys. So we will stream the full earnings call. All right, so Disney coming back down a little bit now. Yeah, so Disney Plus paid subscribers down 2% year over year. ESPN Plus paid subs up 2%. Hulu paid subs flat. So, again, we are putting this number up on screen. You can kind of see the rest right there. Yeah, maybe. Again, we are going to stream the full call at 4:30, which is only in about 20 minutes here, guys. So stick around. You can watch the full call. We'll see what they say during the call. Robinhood flying up, though. So Robinhood posted, I think, good numbers here. Let me see. So Robinhood posted first quarter EPS beat, sales beat as well. So here's Robinhood numbers in the chat as well. Unity doesn't drop theirs until 4:20 today. So Unity still got some time. Still not out with theirs yet. And again, if you haven't already, check out TopStep. TopStep is a sponsor of mine. And so what they do is they give you a demo. And if you can hit the target on the demo in their futures account while following their rules, they fund you. Great way to test your skill. Most people fail these challenges anywhere. But TopStep is the most legit. They pay out millions in withdrawals every year to their funded traders. They fund thousands of traders a year. They're They've been around for over a decade, and the futures market has no PDT rule. It's what most pro day traders use is the futures market, because you can day trade short with a margin account. You can day trade currencies. You can day trade commodities. You can day trade the S&P 500, which is what moves most stocks anyway. And so again, if you haven't checked that out, here is the link. Great way to help support the channel. And really, if you want to get started day trading, a funded account program is something that I truly do wish I had at the beginning. They're a sponsor of mine. I'm biased in their favor, of course. And so naturally, I'm going to be biased in their favor, but check them out. There's the link. Disney down to $99 a share here, 99 bucks. Again, you can kind of see the numbers here for Disney, 93 versus 93 for EPS, revenue of 21.82 versus 21.79. So pretty neutral all the way around for Disney. It wasn't a huge beat, in line with EPS, and not a huge beat on sales. So again, okay, look at Beyond Meat. They posted 92-cent loss, missed the 101 estimate. Sales of 92.2 beat the 91.73. So they beat on both metrics for Beyond Meat. We're putting those numbers up in chat right now as well. Unity's not dropping theirs until 420. Put this up on screen. Put this on Twitter. Supposed to this Disney consolidating. Robinhood coming back down to 920s here. So Disney's consolidating right now. Beyond Meat's pulling back. Robinhood's pulling back. Again, I'm trying to give the market time, but Unity shooting up. Disney mixed results. So yeah, it looks like Unity's out with theirs actually. So let me check out Unity real quick. So Unity Software first quarter sales came in at 500 million versus 481 million expected here. 500 million versus 481 million expected. You can kind of see Unity here shooting up to 3220s for Unity. I don't see the rest of the metrics for Unity here, but we're waiting. Robinhood posted minus 57 versus minus 61 expected, so lower loss than expected. Revenue of 441, expected 420, so higher than expected all the way around. Adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization at 115 versus 94.4. So Walt Disney, again, 93 versus 93. EPS, mixed, neutral EPS, better than expected revenue, but only slightly. Again, I'm putting the Unity numbers up here too. I don't know if you see me. I'm scalping Disney right now. I got 100 shares left. I want to give it time too, but Disney's still waiting here. Again, they're down enough where I could probably front load onto it and take a little bitty dip. Yeah, I don't know about Cake. Scheduled to come out today, but I'm not sure when. All right, look at Unity here. Unity testing highs at $33 a share here for Unity. So 33 bucks a share. I don't see the actual Unity numbers out yet. Oh, there it is. Unity posted 1 cent loss versus 6 cent profit. I'm surprised they're up so much. Revenue of 715 versus 694. higher than expected second quarter revenue guidance is what this is. We'll put this up on Twitter for Unity here. Disney consolidated. We bought a little bit of this dip and then took profit pretty quickly. I'll give it a little bit of time to bounce back because I usually like buying these little pullbacks, but I got to give it some time here. Yeah, trade desk. Disney did pretty neutral. So Disney did pretty flat. They did EPS was completely flat, and then their sales came in slightly better than expected. Only slightly though. It wasn't like a huge beat. Yeah, you can see their Hulu numbers right there. No, I don't see any guidance numbers yet. I don't know if Disney is going to come back to where they were. I really don't know. All right, so we're still consolidating under 99 for Disney here. And again, the earnings call is going to be in about 14 minutes. 14 minutes, guys. BYND. Yeah, BYND, I think they lost less money than anticipated. Yeah, they posted whatever reason my data is not accurate there for them. Let me see. BYND posted 92-cent beat EPS loss versus 101 loss estimate. Sales of 92.2 million beat the 91.73 estimate. Net revenue guidance decrease approximately 10% to 1%. So better revenue here. Their fiscal year 23 revenue guidance came in higher than expected at 415 versus 390 expected. So the revenue guidance came in a little bit higher than expected there. It's probably why BYND reacted so well to this. BYND currently at 1370. So yeah, pretty good reaction there, I think. All right, BYND popping up here though. There's Unity on the right. Yeah, they actually call for Disney's in about 10 minutes. Disney ramping up a little bit. We bought the dip. Took a little bit more off here. It's not a huge trade, but we're just kind of scalping this move. We got 75 shares. I'll give it some time. Unity's still trying to hold. Again, 12 minutes, guys. 12 minutes. Yeah, I'm not super rigid with my Disney trade. Like, it's a small trade. It's 75 shares, so it's not huge, you know. It's still green on the trade. You can see here we're still green slightly. I'm going to let it just work. If it dips down too much, of course, I'll cut it. But I want to give it chances to bounce back up to like 100 plus if we can. But I have to be a little bit... I can't be super loose with it, though. I have to pay attention to it. All right, guys, we got 11 minutes here, guys. 11 minutes, not that long until the earnings call starts. This timer up here so we can get it. But yeah, we got 11 minutes. A little bit less than that, actually. There we go. minutes, just about now. The timer up right here. Maybe I'll put it right above me. There we go. And so you see, I'm only down $10 on Disney. I want to give it time to work through the earnings call, though. Bitcoin pump it up a little bit. Is it really? Yeah, Bitcoin back up to 28,000 here. So, hey, that's not bad. Yeah, PayPal drop was brutal, man. Question is there some extension now on the bottom? I don't know. Yeah, so now we're about $30 down on Disney. Again, I'm not going to be super loose with it. I will cut it if I need to. But I'm also going to be patient enough. Like, we're down $15, $14, you know, so like on the day, we've already scaled out a little bit. I want to give it time. We should get an earnings call bounce. We might. Again, I'm not saying we will. Nobody ever knows if we're going to get a bounce or not is the thing. That's why, like, again, we're pretty flat on the trade now. You can kind of see we're completely flat on the day on Disney now, but I do have to give it some time. Look at Unity pop back up. Unity at 33.40s here, 33.40s. Robinhood all for 24-hour trading of selected stocks and ETFs Monday through Friday. I think that's a great move for them. Again, you can kind of see we're still green on, now we're green on Disney here slightly, so we'll keep letting it work. Yeah, volatile movement. Unity dipping down a little bit. I like the strength that we have here on. I'm thinking about buying Unity a little bit right here too. Yeah, well, tomorrow's PPI data, so that's going to influence everything here. So no matter what happens here, PPI data is going to influence a lot. All right, guys, 8 minutes. 8 minutes, guys. Here, I'm going to switch headphones real quick so I don't forget. 8 minutes before the Disney numbers. Again, we're sitting there at 98.60s right now. All right, so we're at 98.70s for Disney. Kind of sitting back, again, pretty flat on the trade. Luckily, I took profit pretty fast on the pop that we did get. Now we're completely flat. I do want to give it time to work, but I'm not going to hold it forever. We're actually still green on the day. I'm going to knock on wood. Hopefully it holds, but... can y'all hear the music? No, you can't. Here, let me fix that. Let me fix that so y'all can actually hear the music. Hold on one second. There we go. Can y'all hear the music? You should be able to. If not, let me know. I'll fix it. Sound check. All right, guys, we got 6 minutes. 5 minutes now, really. We are ready. All right, guys. So Disney numbers drop at about, or Disney results drop in about 5 minutes, or their earnings call drops in about 5 minutes. We'll give it time, but yes, you can hear the music good. Yeah, the SPY is 24/7, but I don't know if you can trade it 24/7. I'd have to check. Yeah, for sure. What's up, pawn? All right, guys. Yeah, we got a couple minutes here. So yeah, BYND surprised beat for their numbers here. So BYND did well. BYND beat. Unity beat. YouTube Unity. The reason Unity's up so much is because it did better than expected with the guidance. Guidance came in at 2.2 versus 2.13 billion expected. So guidance numbers were positive for Unity. That's what happened here. Is guidance numbers were good. All right, there's Unity pulling back some again. We'll see if it actually holds. Disney, we're not going to hold forever too. We will cut it if we need to here. But we got time. If I do cut it, I might just cut like 25 shares, in all honesty, and chill on the rest. You know, that way I can probably hold 50 shares as long as I really want and not be super stressed about it, in all honesty. And so that's probably what I'll do. Yeah, Unity down under 32s. Again, 3 minutes, guys. 3 minutes. Unity dipping down a little bit from their earnings report. Yeah, hopefully Disney does say a high a bunch. We'll see if they do. Never heard of them, Zach. Unity popping back up a little bit. What's the SPY doing right now? SPY's pretty flat, actually. We'll give it time. All right, guys, a minute and a half left. I guess I'll just hold the Disney trade. It's not super worrisome either way. Even if it does dip, I'm not going to be down too much. This is TD Ameritrade Thinkorswim. All right, guys, a minute left here. A minute left. I'm gonna go to mute this. Turn the timer off. 1 minute, guys. See if they say something positive during their earnings call. Again, I bought a little bit. We'll just wait and see. And I ended up cutting half of the position again just because I can let 50 shares ride as long as I need to. I'm not gonna let too much more past that. So I'll sit on the rest and just wait because I do like buying Disney around $90, and I could probably scale it, I could probably start scaling it here and get into a decent position down to $90. But we got to give it some time, of course, like I always say. All right, Unity bouncing back up a little bit. Uber. I don't know what's Uber been doing, man. Uber monetization problems. They're still at 39s. So yeah. $90 is kind of my go-to buy spot too. All right, guys. Let's start the call. Still on hold, so the call hasn't started yet. I'm also going to mute the music here, so we're waiting for the call to start, so bear with me. Usually they wait till about a minute after the start time to start it up, so just chill, guys. We're going to start Disney earnings call pretty soon. We're on hold waiting for it to start here, guys, so bear with me. No pun intended. Or pun intended, I guess. Still waiting for it to start. We are now past 1 minute after. Still waiting for it to start, guys. Let me get this ready here. Unity at 31s right now, 31s. Yeah, we still got their terrible hold music. Sounds like I'm at Disney World with this hold music. So they haven't started yet for sure. So again, we're still waiting on the call to start. Hopefully after this song, they'll start the call. Uber actually up a little bit, but yeah, they still haven't started yet. We're still waiting for the call to start, guys. So bear with me. Looks like they're running a little bit late with their call here, guys. Again, the call is still not started yet. Hasn't started anywhere else either. Don't worry. Now it's starting.
Good day and welcome to
Sound
the
check.
Walt Disney Company's second quarter 2023
Sound check.
financial results conference call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation,
Sound
there will
check.
be an
Good.
opportunity
Should be
to
good.
ask questions. To ask a question, you may press star then 1 on your telephone keypad. To withdraw your question, please press star then 2. Please note this event is being recorded. I would now like to turn the conference over to Alexia Quadrani, Senior Vice President of Investor Relations. Please go ahead.
Good afternoon. It's my pleasure to welcome everybody to the Walt Disney Company's second quarter 2023 earnings call. Our press release was issued about 25 minutes ago and is available on our website at www.disney.com/investors. Today's call is being webcast, and a replay and a transcript will also be made available on our website. Joining me for today's call are Bob Iger, Disney's Chief Executive Officer, and Christine McCarthy, Senior Executive Vice President and Chief Financial Officer. Following comments from Bob and Christine, we'll be happy to take some of your questions. So with that, let me turn the call over to Bob to get started.
Thank you, Alexia, and good afternoon, everyone. Allow me to digress for a moment to congratulate Universal for the tremendous success of Super Mario Brothers. It certainly proves people love to be entertained in theaters around the world, and it gives us reason to be optimistic about the movie business. Now turning to our results. We're pleased with our accomplishments this quarter, which are reflective of the strategic changes we've been making throughout our businesses. We're also proud of what we continue to deliver for consumers, from movies to television to sports, news, and our theme parks. A few recent highlights include Marvel Studios' Guardians of the Galaxy Volume 3, which topped the global box office in its opening weekend with $289 million. The first round of the NBA playoffs was the most watched ever across Disney networks, and we've been averaging 5 million viewers throughout the first 22 games, up 15% versus the comparable point in last year's playoffs. ABC continued its run as the number one entertainment broadcast network for the fourth consecutive season. And at our domestic parks, we continued to improve the guest experience with our recent pricing changes and exciting new attractions, including the reimagined Mickey's Toontown at Disneyland and Tron Light Cycle Run at Walt Disney World. I've been back at the company for almost 6 months, and in that time, we've embarked on a significant transformation to strategically realign Disney for sustained growth and success. I'm pleased to say that the strategy we detailed last quarter is working. Our new organizational structure is returning authority and accountability to our creative leaders, as well as allowing for a more efficient, coordinated, and streamlined approach to our operations. The cost-cutting initiatives I announced last quarter are well underway, and we are on track to meet or exceed our target of $5.5 billion. We're delivering progress on a number of fronts, including a reduction in streaming operating losses this quarter, and I'm very optimistic about our direct-to-consumer business longer term. Combined, our brands, franchises, and robust library are a significant differentiator in this space, and the meteoric subscriber growth we've seen since our launch 3 years ago only further reinforces that. As I think about our path forward in streaming, we have a number of clear opportunities to further position our DTC business for success. First, as a significant step toward creating a growth business, I'm pleased to announce that we will soon begin offering a one-app experience domestically that incorporates our Hulu content via Disney+. And while we continue to offer Disney+, Hulu, and ESPN Plus as standalone options, this is a logical progression of our DTC offerings that will provide greater opportunities for advertisers while giving bundle subscribers access to more robust and streamlined content, resulting in greater audience engagement and ultimately leading to a more unified streaming experience. We will begin to roll out this one-app offering by the end of the calendar year, and we look forward to sharing more details in the future. Despite the near-term macro headwinds of the overall marketplace today, the advertising potential of this combined platform is incredibly exciting. And when you drill down into the details, you can see why. Over 40% of our domestic advertising portfolio is addressable, including streaming, which we expect will continue to grow over time. We're also focused on the growth opportunity in programmatic advertising, and we are well positioned to scale as the market improves and audiences continue to grow. We've added more than 1,000 advertisers over the past year and now have 5,000 advertisers across our streaming platforms, with over a third buying advertising programmatically today. In addition, we plan to launch our ad tier on Disney Plus in Europe by the end of this calendar year, which will drive both increased inventory and revenue over the long term. The truth is, we have only just begun to scratch the surface of what we can do with advertising on Disney Plus, and I'm incredibly bullish on our longer-term advertising positioning. Meanwhile, the pricing changes we've already implemented have proven successful, and we plan to set a higher price for our ad-free tier later this year to better reflect the value of our content offerings. As we look to the future, we will continue optimizing our pricing model to reward loyalty and reduce churn, to increase subscriber revenue for the premium ad-free tier, and drive growth of subscribers who opt for the lower-cost ad-supported option. Additionally, I'd like to share a few other key areas where we see opportunities for improvements in our streaming business. First, it's critical we rationalize the volume of content we're creating and what we're spending to produce our content. Second, our legacy platforms enable us to expand our audiences and often augment our potential streaming success, while at the same time allowing us to amortize our content costs across multiple windows. We also need to strike the right balance between our local and global programming, as well as our platform and program marketing. Finally, we must continue calibrating our investments in specific markets, looking at the total addressable market and ARPU prospects and evaluating the profitability potential. All of these factors combined are why we are confident that we're on the right path for streaming's long-term profitability. The strength of our content, the one-app experience, and the enormous advertising potential that comes with it, rationalizing the volume of the content we make and what we're spending, maximizing windowing opportunities, recalibrating our investments internationally, perfecting our pricing model, and consolidating our global streaming business under the leadership of Disney Entertainment co-chairman Alan Bergman and Dana Walden. We're doing the essential work now to position our streaming business for sustained growth and success in the future. Turning to our parks, we see this business as a key growth driver for the company. This past quarter, we've been especially pleased with the performance of our parks internationally. We have several international expansions underway that will allow our parks to continue to build capacity and drive longer-term growth. At Disneyland Paris, our Avengers Campus has been a resounding success in its first year, and we have ongoing investment underway there, including a Frozen-inspired land currently in development. Our Zootopia-inspired expansion opens later this year at Shanghai Disney Resort. Arendelle, the World of Frozen expansion, is set to open at Hong Kong Disneyland in the second half of 2023. And Tokyo Disney Resort, which is currently celebrating its 40th anniversary, will be opening the new Frozen Kingdom, Rapunzel's Forest, and Peter Pan's Neverland in the coming year. Regarding our domestic parks, we just announced additional changes coming in 2024 that will improve the experience for guests visiting Walt Disney World, including further expanding access for annual pass holders to visit on certain days without reservations, as well as removing the need for an additional reservation for guests with date-based tickets. This is just another example of how we're continuously listening to our guests and finding ways to improve their experiences. And we have a number of other growth and expansion opportunities at our parks, and we're closely evaluating where it makes the most sense to direct future investments. The unyielding popularity of our world-class parks business and our unparalleled content, powered by our brands and franchises, is what sets Disney apart. From the very beginning, 100 years ago, our timeless stories and characters have been the key to our success and hold a special place in the hearts of generations of fans and families. We're leaning into this across every segment of our business, as illustrated with our strong summer slate of theatrical releases, including Disney's The Little Mermaid, Pixar's Elemental, and Lucasfilm's Indiana Jones and the Dial of Destiny. As we've been looking at the structure of the company these past several months, what's become clear is that there is an enormous opportunity to harness our full potential by increasing alignment and coordination in marketing across our businesses. That's why I named Asad Ayaz our first ever Chief Brand Officer, in addition to his role as President of Marketing for our studios. For years, our businesses have been incredibly successful in marketing our content, experiences, and products. And now, with greater integration of our touch points with consumers, especially streaming, we're able to be more efficient and more successful in reaching the right audiences with the right offerings from across our businesses. Disney means so much to so many people around the world. That's a privilege we take seriously. And I know I speak for our terrific chairmen, Alan, Dana, Jimmy, and Josh, when I say that our goal is to continue finding innovative new ways that allow guests and audiences to have even deeper connections with us. And that's why I'm so thrilled to be taking this more proactive approach to our brand and marketing work. With that, I will turn things over to Christine.
Thanks, Bob, and good afternoon, everyone. Excluding certain items, fiscal second quarter diluted earnings per share were 93 cents, a decrease of 15 cents versus the prior year, as improvements at DPEP and direct-to-consumer were more than offset by declines at our linear networks business. As Bob mentioned, we are making excellent progress on our cost-cutting initiatives and are on track to meet or exceed the efficiency targets we outlined last quarter. During Q2, we took a restructuring charge of approximately $150 million, primarily related to severance. While we are continuing to refine our estimates, we currently expect to record additional severance charges of approximately $180 million over the remainder of this fiscal year, with the bulk of that additional charge expected in the third quarter. We are in the process of reviewing the content on our DTC services to align with the strategic changes in our approach to content curation that you've heard Bob discuss. As a result, we will be removing certain content from our streaming platforms and currently expect to take an impairment charge of approximately $1.5 to $1.8 billion. The charge, which will not be recorded in our segment results, will primarily be recognized in the third quarter as we complete our review and remove the content. And going forward, we intend to produce lower volumes of content in alignment with this strategic shift. Now, to dive into our quarterly results by segment. Starting with our media and entertainment distribution business, a year-over-year decline in operating income was driven primarily by a $1 billion decrease at linear networks. DTC results improved versus the prior year, and content sales, licensing, and other operating results in the second quarter declined modestly. At linear networks, results were consistent with guidance given last quarter, driven by decreases of approximately $800 million at our domestic linear networks and $160 million at our international linear networks. Domestic results decreased at both cable and broadcasting. At cable, this was largely due to higher sports programming and production costs, which were driven by the timing of costs for the college football playoffs and the NFL we discussed last quarter, in addition to NBA contractual rate increases and higher sports production costs. Lower broadcasting results reflected decreases in advertising revenue across the ABC network and our owned television stations. Second quarter domestic linear networks affiliate revenue decreased by 2% from the prior year, driven by a 6-point decline from fewer subscribers, partially offset by 3 points of growth from contractual rate increases. Rate growth was adversely impacted by 1 percentage point from the timing of revenue recognition from certain non-owned TV stations. Second quarter domestic linear advertising revenue declined 10% year over year, although ESPN ad revenue was up 2%, or flat when adjusted for certain non-comparable items, including CFP timing. The sports advertising marketplace is currently stable, with quarter-to-date ESPN domestic linear cash ad sales pacing up. However, the overall entertainment advertising marketplace has been challenging. While the weakness has moderated somewhat, we anticipate that some softness may continue into the back half of the fiscal year. But as Bob mentioned, we are optimistic about our ability to continue to be a leader in advertising throughout the business cycle, particularly as it relates to our capabilities in addressable and programmatic. And we look forward to sharing more details at our upfront presentation next week. International channels operating income decreased versus the prior year, driven by lower advertising revenue, partially offset by lower programming costs. Moving on to the direct-to-consumer, operating losses improved sequentially by approximately $400 million versus Q1. During the second quarter, Disney Plus core subscribers grew modestly, with over 600,000 net additions. For international subs increased by close to 1 million. While domestic subs declined slightly in the quarter from continued impacts from the price increase, domestic ARPU increased sequentially by 20%, reflecting strong subscription revenue growth. And while the softness we saw in Q2 domestic Disney Plus net adds may linger into Q3, we do expect core subgrowth to rebound in Q4. At ESPN Plus and Hulu, subscribers increased slightly over the prior quarter. ARPU at Hulu was impacted by lower per-subscriber advertising revenue, in line with the comments we made last quarter regarding near-term softness in the addressable advertising space. DTC expenses, including programming and production costs and SG&A, declined in the second quarter versus Q1. Our direct-to-consumer operating results in Q2 outperformed our guidance by about $200 million, due in part to timing shifts of marketing expenses driven by recent slate changes at Disney Plus and Hulu. The shift of some of those costs into the third quarter will contribute to Q3 DTC operating losses widening by approximately $100 million versus Q2. As we have noted before, the path will not be linear, as the strategic changes and improvements we're executing on take time to deliver, but we remain confident in our long-term trajectory, with continued opportunities to further improve results given our content curation strategy, planned price increases, expanding our relationships with our advertisers, and our ongoing disciplined approach to costs. At Content Sales, Licensing, and Other, we generated a $50 million loss in the quarter, a bit shy of our prior guidance that results would be roughly break-even. Lower results in the second quarter versus the prior year were due to a decrease in TV SVOD distribution results, partially offset by improved theatrical distribution results due to the continued success of Avatar: The Way of Water. In the fiscal third quarter, we anticipate this business's operating results will decline by $150 to $200 million versus the prior year, driven primarily by timing of the marketing of theatrical releases, with key titles Elemental and Indiana Jones and the Dial of Destiny not premiering until very late in the quarter. Moving on to Parks, Experiences, and Products, operating income increased by over 20% versus the prior year to $2.2 billion, with increases at both international and domestic parks and experiences, partially offset by lower merchandise licensing results at consumer products. Our international parks were a bright spot this quarter, with strong year-over-year operating income growth driven by higher attendance and improved financial results at Shanghai Disney Resort, Disneyland Paris, and Hong Kong Disneyland Resort. At domestic parks and experiences, operating income increased 10% versus the prior year, driven primarily by the continued post-pandemic recovery of our cruise line, partially offset by a comparison to a gain from a real estate sale in the prior year. Q2 domestic parks operating income came in slightly below the prior year, but was still up over 50% versus 2019. Results generally reflect the cost pressures we cited in last quarter's earnings call, including wage increases, costs associated with new guest offerings, and other inflationary cost impacts. Domestic year-over-year increases in attendance and per capita spending were 7% and 2% respectively. Per cap growth was more moderate this quarter, as we are comparing against the first full quarter of offering Genie Plus and Lightning Lane at both parks in the prior year. Domestic parks and experiences operating margins were comparable to the prior year, once adjusted for the impact of the prior year's real estate sale. Please keep in mind that in the back half of this fiscal year, there will be an unfavorable comparison against the prior year's incredibly successful 50th anniversary celebration at Walt Disney World. We typically see some moderation in demand as we lap these types of events, and third quarter to date performance has been in line with those historical trends. This comparison, coupled with inflationary cost pressures, including from a new union agreement is expected to drive a modest adverse impact to domestic parks and experiences operating margins in the third quarter compared to the prior year. However, we expect the contribution from continued strong performance at our international parks in Q3 to result in DPEP segment-level operating margins that are slightly higher than the prior year. DPEP will continue to be a growth business for our company, and we will manage all of these factors in line with our enduring focus on our guests. Before we conclude, I would like to note a couple of items related to our expectations for the total company this year. For fiscal 2023, cash content spend company-wide is expected to remain roughly comparable to last year, excluding any potential impacts from the writers' strike. And we expect that fiscal 2023 capital expenditures will total approximately $5.6 billion. This is lower than our prior guide of $6 billion, largely due to timing of projects at DPEP, as well as lower technology spend at DMED. We still expect fiscal 2023 revenue and operating income to grow in the high single-digit % range. There are still many moving pieces, including macroeconomic factors, the state of the global advertising market, and content timing shifts, which could impact our plans and expectations for the back half of this year. But as Bob mentioned earlier, we are incredibly optimistic about the long-term value creation opportunities that the changes we are currently executing on can generate for our company, and we look forward to keeping you updated on our progress. And with that, I will turn the call over to Alexia for Q&A.
Thanks, Christine. As we transition to Q&A, we ask you to please try to limit yourselves to one question in order to help us get as many analysts as possible today. And with that, operator, we're ready for the first question.
We will now begin the question and answer session. To ask a question, you may press star then one on your telephone keypad. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then two. And our first question will come from Ben Swinburne of Morgan Stanley. Please go ahead.
Thank you. Good afternoon. Bob, I wanted to ask you about what you learned on sort of two topics over the last several months. One is around the price increase on Disney+. You've sort of commented that you think it went well. Obviously, we can see the subscriber trends, and you sound optimistic that the company can continue to drive ARPU over time. I'd love you just talk a little bit about what you've seen in the customer base and reaction and engagement that gives you confidence around pricing power for Disney+ looking ahead. And then a similar question around the cost rationalization and reorg at the company now that you're sort of deep into that. What have you learned about the opportunity for that to drive better financial results for the company? And Christine sort of teased it that there might be more opportunities that maybe exceed expectations. But do you think there's more to do, I guess, is the short question on the cost side. Thank you very much.
Thanks, Ben. On the first question regarding price increases, first, we were pleasantly surprised that the loss of subs due to what was a substantial increase in pricing for the non-ad supported Disney Plus product was de minimis. There was some loss, but it was relatively small. That leads us to believe that we, in fact, have pricing elasticity. With that in mind, I think one of the things that we not only have discovered, but that we believe we have to do is that we've got to widen the delta between the ad-free service and the non-ad supported service, because we clearly would like to drive more subs to the ad-supported service, which we did in the quarter, by the way. The obvious reason, because of the ARPU potential of the ad service Disney+. And in fact, as we look to this upfront, and after careful and considerable discussion with our sales team led by Rita Ferro, we see that there's going to be a substantial growth in digital advertising in this upfront. I mean, quite substantial. Suggesting, for the obvious reason, because digital advertising is so attractive to advertisers, that there's an opportunity for us to really lean into ad-supported. And again, raising our prices on the ad-free, keeping the prices on the ad-supported relatively modest, maybe perhaps no increases, increasing the delta, driving more subs in a higher ARPU direction. So we're heartened by it, and we're optimistic. And that is one of the strategies that we believe will help lead us ultimately to profitability and growth, along with the second thing that you mentioned, which is the cost rationalization. And I'll tag team with Christine on this. Clearly, we, as she mentioned, we're on a path to meeting or exceeding the $5.5 billion in cost reductions that we mentioned last quarter. That comes in two categories: content spend and SG&A. I'm going to let Christine handle the SG&A, but on the content spend, we said at the time most of that will come starting in 24 and leading and into 25, because we were committed to so much content already in 23. I'll let Christine handle the timing of the SG&A reductions and what potential impact that would have. Clearly, again, the price increases, the pushing more viewers or more subscribers to the ad-supported, and the cost containment are among the things we're doing to get to profitability.
Yeah, hi, Ben. I'll just further elaborate on some of the SG&A progress that we've had. And thanks for picking up that. I did tease that by saying that we would meet or exceed our targets of $2.5 billion. But, you know, as we've gotten into this, there's been great cooperation throughout the entire company, which has been really rewarding because we're looking at this. And of course, you know, there's the reality of headcount reductions, and we're going through those. But there's also other things that we're finding more and more opportunities on eliminating redundancies, looking at ways to become more effective by utilizing resources, people and other resources across other businesses. But we're really leaning into all the opportunities. There's technology, which we've also seen a lot of good progress. Some of it will be, and I say some, will be realized in the balance of this year, really at the end of the fiscal year. But the real impact is going to help us in 24. But once again, since we're all into it, I think, once again, having it be company-wide and having, you know, it be something that all of our business leaders have embraced, we're looking for a real comprehensive look throughout the SG&A buckets.
And one more thing to add to that, Ben. We launched Disney Plus in many, many markets around the world, including many very low ARPU markets. And not only did we launch in those markets, we spent a lot of money on marketing in those markets, and we spent money on local content. So as we rationalize this business and we head in the direction of profitability, clearly we're looking at opportunities to reduce expenses in those markets where the revenue potential just isn't there. Thanks.
Thank you both.
Operator, next question.
The next question comes from Phil Cusick of JP Morgan. Please go ahead.
Hi, great to see the parks doing so well. Christine, can you dig into the contribution from Shanghai and where that is relative pre-COVID into its potential? And Bob, Florida is such a big part of the value of the company, but you have this political issue that only seems to get more press. It seems like you're stuck with this fight. So how should investors think about the risk, both the near-term and long-term business for Disney? Thank you.
Hi, Phil. Let me address our results at Shanghai. They were incredibly positive this quarter. We've been really gratified to see the bounce back from the pandemic closures that we had. We're not going to get into too many specifics, but suffice it to say that the business is doing extremely well on both an attendance and a per cap basis. We see that momentum continuing. And we also have some new attractions. We've talked about Zootopia coming later this year, and we believe that that is going to drive even, further attendance and spending at the park. But Shanghai is doing extremely well, and we've been really gratified to see that bounce back. Like I said, it was closed for quite a long period of time during the pandemic.
Regarding Florida, I got a few things I want to say about that, Phil. First of all, I think the case that we filed last month made our position and the facts very clear. And that's really that this is about one thing and one thing only, and that's retaliating against us for taking a position about pending legislation. And we believe that in us taking that position, we are merely exercising our right to free speech. Also, this is not about special privileges or a level playing field or Disney in any way using its leverage around the state of Florida. But since there's been a lot said about special districts and the arrangement that we had, I want to set the record straight on that too. There are about 2,000 special districts in Florida, and most were established to foster investment and development, where we were one of them. It basically made it easier for us and others, by the way, to do business in Florida. And we built a business that employs, as we've said before, over 75,000 people and attracts tens of millions of people to the state. So while it's easy to say that the Reedy Creek Special District that was established for us over 50 years ago benefited us, it's misleading to not also consider how much Disney benefited the state of Florida. And we're not the only company operating a special district. I mentioned 2,000. The Daytona Speedway has one. So do the Villages, which is a prominent retirement community, and there are countless others. So the goal here is leveling the playing. If the goal is leveling the playing field, then a uniform application of the law of or government oversight of special districts needs to occur or be applied to all special districts. There's also a false narrative that we've been fighting to protect tax breaks as part of this. But in fact, we're the largest taxpayer in Central Florida, paying over $1.1 billion in state and local taxes last year alone. And we pay more taxes, specifically more real estate taxes, as a result of that special district. And we all know there was no concerted effort to do anything to dismantle what was once called Reedy Creek Special District until we spoke out on the legislation. So this is plainly a matter of retaliation, while the rest of the Florida special districts continue operating basically as they were. And I think it's also important for us to say our primary goal has always been to be able to continue to do exactly what we've been doing there, which is investing in Florida. We're proud of the tourism industry that we created, and we want to continue delivering the best possible experience for guests going forward. We never wanted, and we certainly never expected, to be in the position of having to defend our business interests in federal court, particularly having such a terrific relationship with the state as we've had for more than 50 years. And as I mentioned on our shareholder call, we have a huge opportunity to continue to invest in Florida. I noted that our plans are to invest $17 billion over the next 10 years, which is what the state should want us to do. We operate responsibly, we pay our fair share of taxes, we employ thousands of people, and by the way, we pay them above the minimum wage, substantially above the minimum wage dictated by the state of Florida. We also provide them with great benefits and free education. So I'm going to finish what is obviously kind of a long answer by asking one question. Does the state want us to invest more, employ more people, and pay more taxes, or not? Thanks.
Thanks, Bob.
Operator, next question, please.
The next question comes from Michael Nathanson of MoffettNathanson. Please go ahead.
Thanks. I have two. Bob, first for you is, what do you think the impact of the slowdown in your DTC content spending will have on global subscriber growth? And then what does the move to one app in the U.S. offer as a solution? And Christine, any help on future cash content spending? You said this year is flat. Is this the peak year and then we start seeing declines from this year? Any help there on future cash content spending would be helpful. Thanks.
Michael, when we launched the service, let me remind everyone, it was only 3.5 years ago, so we're still a startup in many ways. The goal was, as you know, global subs, and we wanted to flood the so-called digital shelves with as much content as possible to achieve, obviously, as much sub growth as possible. And now, as we grow the business in terms of the global footprint, we realize that we made a lot of content that is not necessarily driving sub growth, and we're getting much more surgical about what it is we make. So as we look to reduce content spend, we're looking to reduce it in a way that should not have any impact at all on subs. We believe that there's an opportunity for us to focus more on real sub drivers. And one interesting example, and I should also throw marketing in too, where when you make a lot of content, everything needs to be marketed. You're spending a lot of money marketing things that are not going to have an impact on the bottom line except negatively due to the marketing costs. One thing we also know is that our films, those that are released theatrically, big tentpole movies in particular, are great sub-drivers. But we were spreading our marketing costs so thin that we were not allocating enough money to even market them when they came on the service, as witnessed by the ones that are coming up, including Avatar, Little Mermaid, Guardians of the Galaxy, Indiana Jones, Elemental, etc., where we actually believe we have an opportunity to lean into those more, put the right marketing dollars against it, allocate more from basically away from programming that was not driving any subs at all. So I guess this is part of the maturation process. As we grow into a business that we had never been in, we're learning a lot more about it. Specifically, we're learning a lot more about how our content behaves on the service and what it is consumers want.
Hi, Michael. I'll address your question on content spend. As you know, this is an area that Bob is spending a lot of time working with our creative teams on. But when you think about that $30 billion overall, and Bob's targeted a annualized saving in the $3 billion range, I just want to remind everyone that the sports component of that amount is now over 30%, just due to the contractual rate increases that we've had in our contract rights, our sports rights. The other thing is in fiscal 23, we said that we're going to be roughly comparable to last year. Remember, last year we came in slightly below 30 billion. And this estimate does not include any potential impacts from the writer's strike. So we have not estimated that because that's a new development, and we haven't really quantified what that would be because we don't know how long it's going to last. But in general, what we're really doing is looking at a lower volume of content, as I mentioned in my comments, and Bob is once again going through all of the development slates and really looking at not only our Disney branded, but also a more curated approach to our general entertainment content.
Operator, next question, please.
The next question comes from Jessica Reyes Erlich of BofA Securities. Please go ahead.
Thank you. Bob, you mentioned that in the upfront, you will take a bigger share. I mean, you'll lean heavily into digital and AVOD. I'm just wondering, in the face of accelerating pay TV universe decline, is that enough to offset linear losses, or when will it be enough to offset linear losses and start to drive growth? And in the sub-universe decline thought, I'm just wondering if you can give us your updated thoughts on ESPN and how it transitions and when it transitions to ESPN+.
Well, so I'll address the ESPN first. We haven't really changed our position regarding basically migrating ESPN's flagship service as a direct-to-consumer or streaming platform. We think there's an inevitability to that, but it's a huge decision for us to make, and we know that we've got to get it right, both in terms of pricing and timing. And obviously, that has not only a direct impact on the linear channels, but it will have an even greater impact on it if we were to do that. What we see going on at linear networks, as you know, I'm not saying anything that you don't know, is we're seeing both sub declines and advertising weakness. And it's created, worrisome circumstance for us because it's obviously having such a negative impact on the economics of that business. And that's forcing us to take a look at the cost structure of those channels, which ultimately comes down probably more than anything to spending on programming. The decline in the business is, by the way, something that we predicted starting in 2015-16, which is why we got into the streaming business to begin with. But the declines that we're seeing, put even more pressure on us to turn that streaming business into a profitable growth business for us. And that's why all of the steps that we're taking, both in terms of the organizational structure, the cost reductions, the marketing changes, the changes in how we program, the lean into advertising. We've also, by the way, Jessica, we've invested a fair amount in the technology needed to serve advertisers digitally much more effectively with automated sales functionality and delivering in a very, very granular way exactly what advertisers want. So we're very bullish about leaning into digital advertising. We're bullish about how we're positioned there. We're bullish about Disney Plus and Hulu and that combination, by the way. We think that by making Hulu available as a one-app experience will increase engagement and increase our opportunity in terms of serving digital ads and growing our advertising business. So all things are kind of connected, ESPN to the long-term health of the bundle, the growth and the need to grow streaming as a reaction to the deterioration of linear businesses, and of course, all the steps that we've been taking to get to profitability.
All right, operator, next question, please.
The next question comes from Kannan Venkateshwar of Barclays. Please go ahead.
Thank you. Bob, on Hulu, the revenues of Hulu make it one of the biggest streaming businesses around, and it's also one of the oldest services around, but it doesn't seem to be profitable despite the scale. And sounds like you've made up your mind on buying the rest of Hulu based on the announcement of the combination with Disney Plus. Does this combination allow you to change the cost structure of Hulu by maybe dropping content spending or the number of titles on Hulu and raising price on, because it's now a single service? So any color on your plans with Hulu would be much appreciated. And Christine, on the parks, could you help us scale the impact of the recent wage increases in Florida and how that might impact the year? And historically, the business has delivered mid-single digit or better revenue growth and EBITDA growth faster than that. You now have a number of cruise ships, more attractions, higher price, but also higher costs. So could you help us think about the growth algorithm going forward more broadly? Thank you.
Kannan, as you know, we have a contractual arrangement with Comcast that will enable them to put their share of Hulu back to us in early 2024. Starting in early 2024, there's a, further right that we have to call their share from them. And it's not really been fully determined what will happen in that regard, except that as we've looked more and more at the growth of the future of our streaming business, and I mentioned at the first earnings call that I did after I came back that everything was on the table. And in fact, everything was on the table, but I've now had another 3 months to really study this carefully and figure out what is the best path for us to grow this business. And it's clear that a combination of the content that is on Disney Plus with general entertainment is a very positive, is a very strong combination. From a subscriber perspective, from a subscriber acquisition, subscriber retention perspective, and also from an advertiser's perspective. So where we are headed is for one experience that would have general entertainment and Disney Plus content together for the reasons that I just described. How that ultimately unfolds is to some extent in the hands of Comcast and in the hands of basically a conversation or a negotiation that we have with them. I don't want to be in any way predictive in terms of when or how that ends up. I can say we've had some conversations with them already. They've been cordial and they're aimed at being constructive, but I can't tell you, and I can't really say where they end up, only to say that there seems to be real value in having general entertainment combined with Disney Plus. And if ultimately Hulu is that solution, we're bullish about that.
Hi, Kannan. Let me address your question on parks earnings growth and the outlook there. So I think the way I would phrase this is we do expect a really solid year overall for our domestic parks. That being said, we also expect increased costs, and we alluded to that in our first quarter earnings call. And they're really coming from a few areas, most predominantly. One is wages with a new union contract, coupled with inflationary trends. We do have some new guest offerings, so there's some incremental operating expenses that come along with those. And we also have the operational support for adding a 5th cruise ship to our cruise line fleet. I think you all know that we launched the Wish back last fall. So we continue to look at ways to address cost management. The team down there has done, a great job throughout the pandemic and then coming out of the pandemic, but they utilize a variety of tactics to mitigate potential margin pressures and downside risk across the segments. And some of the levers that they can, utilize to really address it are, by looking at capacity. In some of our new attractions, they increase the footprint or increase capacity so we can open up the valve a little bit more on attendance. And with some new attractions that are more based on newer IP, so that'll get more people not only coming in, but wanting to come in and enjoy the experience while they're there. And we also are really continuing to focus on meeting our customer needs there. But we think that, this is a growth business for us. We've said so in the past. And I do just want to give a call out to our cruise business. That business, as you know, was the most impacted. And we had talked about that was going to be the last business to come back from the closures during the pandemic. But that business has come back incredibly strongly over the last year, this fiscal year. And even looking out to the balance of our fiscal year, we're very encouraged by what we're seeing there and the reception to not only our new ship, but also our legacy ships within the fleet.
Operator, next question, please.
The next question comes from Michael Morris of Guggenheim. Please go ahead.
Thank you. Good afternoon. Wanted to ask one on direct-to-consumer advertising, and love to hear any early details you can share about the Disney Plus with advertising product. It wasn't mentioned as a driver, and I realize it's early, but would love to hear any early takes there and thoughts about how that might pace over the course of the year. And then second, Bob, I'd love to ask about artificial intelligence. Clearly a very hot topic right now. And a technology that seems like it could be pretty impactful to your business, both your ability to use it, but also just given how much intellectual property you have to protect something that could be a threat as well. So love any takes that you can share on how that would impact the business over time. Thank you.
Not to get cheeky, Michael, I'm looking forward to a time where maybe AI does earnings calls for me. You wouldn't know the difference, perhaps. Maybe they'd be better. I don't know.
I'd use AI to ask the questions too.
It's pretty clear that AI developments represent some pretty interesting opportunities for us and some substantial benefits. In fact, we're already starting to use AI to create some efficiencies and ultimately to better serve consumers. Getting closer to the customer is something that is a real goal of ours, and we think that AI will provide some great opportunities to do that. But it's also clear that AI is going to be highly disruptive. And it could be extremely difficult to manage, particularly from an IP management perspective. I can tell you that our legal team is working overtime already to try to come to grips with what could be some of the challenges here. And we're certainly not the only ones. I think this is across not only our industry, but industries. So I'd have to say, overall, I'm bullish about the prospects because I think they'll create efficiencies and ways for us to basically provide better services to customers. On the other hand, I think that there's a lot we're going to have to contend with that will be quite disruptive and quite challenging. Getting more specific is not something I really am prepared to do right now.
And hi, Mike. I will take the Disney Plus ad tier question for you. As you know, we launched back in December, so we've just begun to scratch the surface of what we can really do on advertising on Disney Plus. And we look at this as an incredible opportunity for longer-term advertising positioning. Just to remind everyone, we do have a lighter ad load on Disney Plus versus what we have on Hulu. And also, notwithstanding the very challenging macroeconomic advertising market, we're still seeing our consumers come into the not only existing but also new signups come into that ad tier. So we're very encouraged by that. As Bob has mentioned previously, we have invested a lot in our ad tier technology and our data platforms for really providing state-of-the-art programmatic and addressable add tools to our advertisers. So those are also investments that we've made and we believe are going to pay off not only today, but position us well for the future as the ad market overall gets stronger. The other thing I just want to mention is we will be launching the ad tier on Disney Plus in Europe by the end of this calendar year. So that'll be another platform that we'll have, or another offering that we'll have for consumers outside of the U.S.
Operator, we have time for one more question. Operator, one last question, please.
The last question comes from Doug Mitchelson of Credit Suisse. Please go ahead.
Thanks so much. Just stuck me in. Good afternoon. Bob, integrating Hulu into the Disney Plus app is intriguing, so I wanted to continue that conversation. When Disney Plus was launched, you noted consumers should not have to buy through your entertainment content to get the Marvel and Star Wars and Disney and Pixar content, and you thought at the time having separate services to give consumers choice was the right approach. Is that still the right approach, to have multiple services to give consumer choice? And if the answer is yes, but you want the efficiency and flexibility of a single app, that would suggest that Disney Plus is finally turning into a platform. And I'm just curious if you see the opportunity to broaden the number of subscriptions that can live on that Disney Plus platform, or if you can expand the monetization of that platform in other ways while maintaining a premium experience for consumers. And if I could just add one for Christine, is fiscal 3Q the peak for streaming losses? Thank you both.
We, on the integrated app experience that we announced today, that's for consumers that have subscribed to both services for now. So in other words, it's taking what we call the dual bundle and putting it together in one experience, which is obviously good for consumers. Why have to close out one app and open another one? So it becomes a one app experience. We also think that it will benefit basically consumption in general, lower churn, be more attractive. It's just an all-in-one. It's a bigger platform, basically more content than it offered before. Outside the United States, we created that with Star, which doesn't have all the programming of Hulu, but it has a significant amount, and it's working quite well. And it's one of the reasons why we're going to launch that as an advertiser-supported platform, as Christine mentioned. So I think to answer your question, we're bullish about an app that goes well beyond the Disney Plus branded content and includes general entertainment, which maybe at one point I called undifferentiated. That was a little harsh. But that includes quality, curated general entertainment for the purpose of growing advertising, growing subscriber fees, growing engagement, growing lessening churn, and to address one part of your question, reducing costs.
Hi, Doug, and I'll answer your question on the direct-to-consumer losses and the peak losses. Just to remind everyone, we did say, and it is the case, that we had peak losses in direct-to-consumer in the fourth quarter of 22. That was the quarter that we reported in November. So what you've seen since then is we improved on a sequential linked quarter basis. You've seen a $400 million improvement in Q1, another $400 million improvement in Q2. In my comments, I did say that Q3, it would widen out by $100 million because of the timing of some releases and particularly the marketing of those releases. But that will be an aberration because it's not a linear path, but we will be improving significantly from 22 peak losses in Q4 through the balance of fiscal 23. So you should assume that what you saw back in Q4 was the peak loss, and we have improved for the next 2 quarters. There'll be that one little blip in Q3, and then we expect to be back on the path for the balance of the fiscal year.
Very helpful. Thank you.
Thanks.
Okay, thanks for the question. I want to thank everyone for joining us today. Note that a reconciliation of non-GAAP measures that were referred to on this call to equivalent GAAP measures can be found on our investor relations website. Let me also remind you that certain statements on this call, including financial estimates or statements about our plans, guidance, or expectations, or other statements that are not historical in nature, may constitute forward-looking statements under the securities laws. We make these statements on the basis of our views and assumptions regarding future events and business performance at the time we make them. We do not undertake any obligations to update these statements. Forward-looking statements are subject to a number of risks and uncertainties, and actual results may differ materially from the results expressed or implied in light of a variety of factors, including economic or industry conditions and execution risks, including in connection with our organizational structure and operating changes, cost savings, and DTC business plans relating to content, subscriber, and revenue growth and profitability. For more information about the key risk factors, please refer to our investor relations website.
All right, guys. So that is it for today's earnings call. Let me know what you guys think about it. We're still in a little bit of Disney on the dip. Our average is pretty close to 97s. So we'll be okay. I think we're just going to let this one roll and maybe add if it dips down a little bit more. We'll see what happens. But yeah, y'all be safe. Y'all be good. Tomorrow is PPI inflation data. So this is actually a pretty big report coming out tomorrow morning. And so again, be ready for that. That's actually a pretty decent sized report that again is coming out tomorrow morning. So y'all be ready. Y'all be safe. We'll see you guys a little bit later. Y'all be good. And yeah, that's it for today, guys. Good luck. We'll see you guys tomorrow morning, bright and early.